What you can do is you set up a situation where you've already done your butterfly potentially, and if you have money in excess, so you earn $100,000 a year, pay tax at 13.5%, you end up with $86,500 in retained earnings in the form of cash and OPCO. Well, that's safe income, so you can pay that up to the holding company. Now, one thing to keep in mind, by the way, why is that a problem before you get here? Say you didn't have all this. Why would it be a problem to leave the money sitting in Holdco? Like, there's no credit proofing issues, right? You've moved it up to Holdco. Oh, yeah, that could be, yeah. The loss of small business deduction, 1 for 5 could be an issue. But what else could be an issue with having the money sitting in here?
That's tainted.
Yeah, it would be. That's precisely it. But what do you mean by tainted? Let's explore it.
Qualified small business share for purposes of the capital gains exemption.
Precisely.
Yeah.
But I can't tell you how many situations we've seen, I'm thinking more than dozens probably over the years, where somebody said, yeah, but it doesn't matter because my accountant told me that as long as we got it out of here, we're purified, we don't have to worry about the money sitting here. But why is that not true?
The Holdco shares are the ones that you can sell.
Yeah, they are.
Yeah, you'd be selling the Holdco shares.
Because they don't do OPCO, which is the thing that's eligible. So Holdco's selling the OPCO shares.
Oh.
Holdco,
So it itself needs to be eligible.
Yeah. I know.
So yeah, when you think about it, right? And again, all of these little things are small, but they're big, right? And they require thought. So you're saying, well, who's eligible for capital gains exemptions?
Individual.
Not corporations. So Holdco can't sell OPCO. And yet here's a business owner that has $1 million sitting up here, and he's offside. He doesn't know it. Nobody ever told him. He's got to get that out. We can butterfly over to here very easily. So that's what I would probably do. I'd just, if you had a lot of money sitting there and it's not safe income from, say, the immediate last year, rather than worry about safe income, but butterfly it over. Then, moving forward, we've got a solution for them. So in other words, you can pay an intercorporate dividend from OPCO up into Holdco, up through the family trust, and back down to a corporate beneficiary. And there's no Part 4 tax on dividends being paid through the trust and back down to the corporate beneficiary, providing that the same shareholder, same individual controls both companies. And that is how, or one way, that you can purify every year without needing us.
Ever do the butterfly again? You did the butterfly initially.
Yeah,
You don't have to do it again once you put the trust above that.
exactly. And we've taken these non-active assets, we put them in this pocket over here, see? And we've isolated these things, right? And we've separated the non-active assets from the active assets. The building is over here, which is good. Equipment, building, machinery, all that stuff is all sitting in this company. And John can sell his shares and trust can sell the shares, and this is only a beneficiary of the trust, so therefore it can be the recipient of the dividend tax-free. So it's tax-free right through on the dividends tax-free.
Would you tell your client that system worked? Because I wouldn't.
Okay?
I think it's a little ridiculous. It goes from OPCO up to Holdco to Trust down to Cisco. That doesn't make any sense.
Well, what it does make sense is that you're able to get the cash out of the company with no tax. That's why it makes sense.
If you do it every year, do you think you're going to?
Every year you can pay the dividends. They don't need us. All they do is pay up a dividend. The accountant books it properly as a dividend. There's no tax on it. Once you get used to it, it seems a bit much in the beginning. But afterward, when you can just simply write the check, move the money, and you purify.
Okay.
So what if you have, OPCO is owned 50-50 by two non-related individuals? Now you have a problem because the Holdco, it has to be Holdco and Cisco controlled by the same company, or by the same individuals?
Yes.
So if, okay, I guess that would still work, because then the other Holdco is owned by the other person who owns 50% of OPCO. They would just have their own side co, so they'd have, or sister co.
Yes.
So Holdco and sister co of theirs that owns their OPCO shares would both be controlled by them as well.
Yeah, so you could...
So you would just have the mirror image of this, essentially on the other side for the other person.
For
Precisely.
people who are not.
Precisely, they are not related, as long as they're not related.
That's right.
But if there's a relationship, then
Mhm.
something else
This one.
is a problem.
Yeah, and that's another reason that you say, well, let's set up, instead of using one holdco and having all these unrelated people in it, each shareholder has their own holdco.
Right.
And then they can butterfly the money out of their own holdco if they needed to, right? And everybody can receive dividends without being taxed on it. If they don't need the income, why pay the tax as a dividend?
And siblings are not related.
So the way that you deal with it, by the way, if there's siblings or if there's unrelated individuals, is through 55(3)(b), which means you have a pro rata distribution of all three categories of assets. All right? Basically, you're looking at moving everything, a split up.
Can you say that again, but more slowly?
Oh, sorry, 55(3)(b)
Yeah,
is for unrelated shareholders or siblings.
yeah,
And in that situation, you have to do a pro rata distribution of all three categories of assets: business assets, investment, and capital current, and so on. So you have to split up all the assets equally between the proportionate shareholders. So if they own 50% each, you split it up 50-50. If it's some other distribution, whatever the percentage of shareholdings are, you have to split it up. It's basically a way to wind up a company, in fact, right? So you can't do this kind of planning that I've been describing where you have non-related persons or siblings. I mean, you can do, you can certainly set up ways of splitting the money up, but not, in the same way. Okay.
Okay, sorry, I'm confused here. So Dan just said that if, for as many people are in OpCo, you could do the same structure with each of them having their holdco. But would those people not be unrelated?
They would be,
Yeah,
but
for the
you're
most part.
you're doing a butterfly from a corporation which only one person, each say there's two shareholders. So when you described the mirror image a minute ago, right? So you have one OpCo with two holdcos.
Right.
Okay, the common shares of OpCo are held equally by each one of them.
Right,
So we have John and say Joe. Well, each John and Joe would just do their own butterflies,
right.
and that's
I
fine.
got that.
Yeah, that's good though.
But then you just said with 55(3)(b, pro rata distribution of all the three categories of assets for siblings or unrelated.
Yeah, what I meant was, say as an example, in Holdco, John and his brother are shareholders here, or John and someone else who's not related to. Or say as an example, you have one operating company and you have siblings or unrelated shareholders, okay? Then you'd have the problem. You can't butterfly from OpCo if you have unrelated individuals without splitting the company up.
Okay.
So you really,
You can split, you can still, so you have your individual holdcos.
Right,
And then you butterfly through the holdco, right?
right, so by having the
Go to that
holdco,
next step
that
up.
makes 55(3)(a apply.
Exactly.
Okay,
yeah, it can. You got to be careful on who the shareholders are, right? Because a lot of different ways. Like we just look at all these things as building blocks.
right,
So how do we, like first thing we do is we say, okay, we want to achieve clarity. We want to understand, help the business owner to understand the issues, right? Then what are the goals? And then we use these building blocks to create a tax plan. And it can be double the amount of triangles and squares, or it could be half the number. What we usually try to do is make it simple, if we can.
right.
Some of these things make it more complicated than we want to.
Sure, sure.
To Don's
So
point.
if you were to summarize what the criteria would be then to decide on how many triangles and squares and whatnot, would it be number of shareholders in OpCo, whether or not there's a relation, whether or not there's siblings? Like what would be, would there be 5 things you could say, 3 things you could say for sure would be what you would base it on? If it's this, then it's that, if it's this, then it's
Yeah, so definitely,
decision-making.
yeah, definitely the biggest one is whether they're related or not.
Right,
All right, so the second thing to consider is, in this whole scenario, what are the objectives? What are we trying to do? 1, we're purifying. 2, we're creditor proofing. 3, we're multiplying the capital gains exemption. How are we multiplying the capital gains exemption here?
And the trust. And the trust.
Yeah, most business owners don't know what a family trust is, right? So we always figure, well, let's make it real clear. And the way we like to explain this is to say to them, look, the easiest way to understand a trust, family trust, is every time you mail a letter, you enter into a trust arrangement. Canada Post is the trustee. Whoever you address the envelope to is the recipient. That's the beneficiary. So essentially, that's what a trust is. So when we set up a family trust, like we first of all explained to them. Now in this situation, you would have frozen John. It doesn't say that. I was talking about a different subject, so I left a lot of little details out. But typically, John would exchange his common for prefs, right?
Yeah.
Right? And we say, look, you can't just start giving your shares to your wife and your children because it's going to cause you to pay tax. So how do you explain it? First of all, freeze. Well, right now you own common shares. If the company grows, say it's worth $1 million, it grows to $2 million, well, your shares are worth $2 million. If the company's worth $1 million right now, that's the value of your common shares. What we're going to do is we're going to freeze it at $1 million. So your company can grow to $10 million, your shares are only going to be worth $1 million. Never a penny more. How do we do that? Well, common shares that you have now, they grow. The other kind of shares are the preferred shares, and they have a stated value. And there's no tax. We exchange the common shares you have for preferred shares that don't grow at $1 million. That's it. Then we're able to issue new shares of a nominal value to the trust.
Right.
Right? That's kind of just an easy way to help people understand something that sometimes, you know, if you don't have the conversation 15 times a day, it's harder to describe it, right? So that's just an easy way to help your client to understand what a freeze is and what a trust is.
When would you consider to crystallize the capital gains exemption?
If I thought the capital gains exemption was going to disappear, I suppose I would. I wouldn't bother.
And in the trust, now with the new TOSI rules, administratively, I guess they gotta make sure that if they give a dividend to any of those beneficiaries, that they satisfy that 20-hour-a-week rule,
Exactly.
right?
Exactly. I'm surprised by hearing how many people will say, oh, but you can't accrue capital gains anymore. Of course, you don't realize the government backed that off that in the budget, right? They threatened to take that away.
Yeah.
And I'm glad they didn't. I mean, quite candidly, like it would have been good for us, I guess. We would have been coming up with all kinds of solutions, right? But very bad for business owners, right? So what I would say is that there's a lot of misconceptions. The TOSI rules are real and they're here. The accrual of capital gains tax to the beneficiaries of trusts are, for now, here to stay. I mean, I would have been thinking more about crystallization and stuff like that had they have taken that away, but anyway, they backed off, and of course, protests right across Canada, from tax groups, farmers, fishermen, everybody were.
If you did crystallize it, though, what would be the harm?
There's no harm.
Is it difficult to do?
No, you just increase the ACB. Yeah.
Potential any,
There is-
issues or anything like that.
And just
Trigger
report it
tax
under
issues.
tax today, right?
Yeah.
Commercial term.
Well, so basically, what we're talking about now. By the way, I think I had a slide on more on freezes. Maybe not. I guess I didn't. All right, so maybe we'll just use this slide because I thought there was one. But basically, what are the attributes of free shares? Pref shares, like basically the other thing to keep in mind is the dividend should be a reasonable rate. We usually go at 7% of redemption value. All right? Because how do you argue otherwise? And the other thing is, should they be participating? Should it, yeah. Mm-hmm. Non-participating. What comes from the fact that they have a stated value?
Yeah, that would be contradictory, wouldn't it?
It would be, yeah. But you see, it can be, if you had an unlimited amount of dividend, you're going to pay. Another thing is, what about control? CRA backed off it now, but they were talking for a long time about, arguably there's an added value if you're controlling the company. Right? So if you have prefs and they're voting as well, that's arguably worth more than if they're non-voting. Right? They've kind of backed off that one. But more. Oh, by the way, has anybody used stock options for unrelated shareholders to introduce? That's not on here, so it's warming up. Has anybody done that? So you have like a key man who's valuable to the company, who's an employee of the company, and you want to give him some shares. The guy's been there for forever, and you say, well, what we do is we're going to issue him stock options with a strike price of, say, $100. And, of course, the $100 becomes the ACB. He receives them. It's not taxable until he redeems or disposes of them. Sorry. And Section 7 of the Act, providing it's a CCPC, there's no employee benefit conferred on him if it's a CCPC, right? So what happens through dilution, you can actually reduce the value of another shareholder's share. Say that he owns 100%, and you introduce 50, well, then there's no tax on the disposition through dilution. It's an interesting concept. It only works with individuals who are at arm's length. So with this situation, we have $1.5 million sitting in this professional corporation. We've just done a simple butterfly, basically over to a holdco. This guy, we just basically said, well, look, we'll just say that he's got $1 million of value. We'll do a freeze at $1 million. And then we issue common shares to the holdco. He only ever is going to have one capital gains exemption, so it doesn't really matter because none of his wife or children are able to be shareholders either, directly or indirectly. So he can pay up dividends each year from his professional corporation up to holdco. We purify once through a butterfly, and we just freeze them at $1 million. At the end of the day, it's far less contentious and probably not so much need for evaluation simply because of the fact that the value is going to him in both places, right? Yeah.
How can Holdco own shares in a professional corporation?
Yeah, so it'll depend on the rules of the professional corporation, but there's certainly no reason it can't.
But an accounting firm.
Yeah, so one that I'm thinking of is the Ontario Association of Physiotherapists,
Oh, okay.
and they can.
I jumped to accountants where I was recently.
Oh.
Oh, I can't do that.
So I think you have to look at the rules of conduct, the rules for every organization and see what they are. But certainly I know that works for physiotherapists. And a lot of them have a lot of cash sitting around. Must be profitable businesses. Please.
So in regards to physiotherapists,
Mhm.
if actually both spouses are physiotherapists,
Mhm.
but only one is a shareholder of the PC,
Mhm.
that could introduce a few options too, wouldn't it? Like-
Oh, yeah. You'd have a second capital gains exemption, right? But this is where the presumption is there's never going to be more than one. Just a simple way to purify. And anyway, I don't want. I just wanted to. I'm just going to finish on something. These are structures that shouldn't exist. We see this all the time, right? Guy's got life insurance. He's got a building that's only 50% occupied. He's got $100,000 in cash. He's got marketable securities of $75,000, and he's offside for the capital gains exemption. He's vulnerable to creditors. These shouldn't exist. I mean, to be blunt, but they shouldn't, right? This situation as well, where they've paid up dividends. They have all the assets up here. Again, they have no capital gains exemption, right? I'm just summarizing so we can finish up. This is a question: is this a problem? So, John owns the holdco, and his wife owns the realco, which is the building. Is that a problem or not? Okay. Mm-hmm. But
Realco's not eligible for the small business deduction,
okay, that's true. Realco is not eligible for the small business deduction.
and hence it wouldn't be QSBC either.
Okay, that's $1 million question. Is the shares on the realco eligible for the capital gains exemption? Are they QSBC shares? What does it say at 110? It says that this applies for related companies. Companies who are related to an active business corporation, which meets the definition of a small business corporation according to the Income Tax Act, and related companies. So the quick answer is the growth on the building and the value of the shares is part of what they should be looking to claim as capital gains exemptions. These are related corporations. They're not, somebody said not associated, right, which is correct. Well, they could be. We're not claiming two small business deductions anyway, but try doing it and they might have a problem with it. But the real issue is the fact that these two companies are related. So 110.6 provides that the growth on the building through the corporation would be claimable, be part of your capital gains exemption. So the building's worth $1 million, it grows to $10 million. They've got several kids, they have future grandchildren. By the way, on trust, just to finish up, how many of you are in the habit of saying, let's set up a trust to introduce family members? Yeah?
Yeah.
Okay. So trusts are good for a couple of reasons, right? So we all hope our kids will marry well, and they probably will, but it's not always reality. If they marry badly, you could lose part of your corporation to a stranger, no? Being a beneficiary of a trust does not constitute a matrimonial asset. Not likely would be attached in the event that there was a court order because of the fact they don't own the shares, just beneficiaries of the trust.
Does it matter how you give it to the trust?
Yeah, trust will subscribe
Do you
for
have to
shares.
gift it, for example, in order to be,
All right.
avoid the family property?
So typically in a trust, you have what three parties? You have a trustee, beneficiary, and
So,
settler. All right. So settler would contribute $20. We staple a $20 bill to the deed, right? And then we'd have perhaps the same individual gift $100 to the trust, who give them the money to subscribe for the shares, as an example.
yeah.
All right? So bottom line is, we explained how simple a trust is. It's just this arrangement. It's like mailing a letter, right? It's standard. It's not risky. It's just it's a good way to do it. It gives you the discretion to be able to repatriate the shares back to yourself. In 10 years, you might say, why did I do that freeze anyway? You know, I'm going to, because the trustee, as part of the beneficiaries, the trustee will also be a beneficiary. So he can decide just to repatriate the shares back to himself. He owns the prefs already. Well, I want to just thaw the freeze. Well, it's a great way to thaw the freeze. You say, okay, I'm going to give myself back all the growth too. So you own everything. Or I give my wife 50%, or I give all to my kids, or I give one kid to treat differently than another. It's fully discretionary, right? What about the way that it's set up if a child dies? Are you familiar with the term per stirpes? Okay, all right. What about how many wills should you have?
2.
Okay, one for the corporation, you don't want to pay probate. By the way, over here we have questionnaires you can use for your clients if you want to take them. For setting up wills, we also have shareholder agreements, questionnaires, you can get them to fill out, right? And obviously, you know, we're happy. And what else do we have? There's another wills, shareholder agreements. Sorry?
Trust?
Oh, trusts, yeah. There's a questionnaire for trusts. Thank you. All right, so feel free to take them if you'd like to. And, you know, there's also there's handouts to this presentation.